Welcome back to Ask the Compound, the show where you ask and we answer. I'm your host, Ben Carlson. We've seen some crazy moves in the stock market this decade. Meme stocks, quick crashes, even quicker recoveries. Is this the new normal? Should investors expect this volatility to continue going forward? Or is this just another cycle that will go away in the future? We answer these questions and much more on today's show. All right, welcome to everyone in the live chat on YouTube as usual. I'm watching on Twitter.
Did you come up with that off the fly? You ask and we answer? It's pretty good.
Pretty good, right?
Yeah, I like that.
I probably stole it from ChatGPT, but I'll take it as my own. I don't know. Askthecompoundshow@gmail.com is our email here. Send us all your questions. A ton of them this week. On today's show, we answer questions straight from our compound audience. Is all the market volatility in the 2020s normal? How to manage RMDs in retirement when you have $30 million? This is true. How to be a good client for your financial advisor, new tax alpha strategies and how they work, where all of your assets should be located, and whether or not a guy in Colorado should back out on a house purchase to keep saving and investing. Today's show is sponsored by Public, the place where serious investors go to manage their money. Public isn't just another investing app. It's a powerful platform where you can build a diversified portfolio across stocks, bonds, crypto, options, even treasuries all in one place. Want your cash to work a little harder? Public offers a 4.1% APY on your uninvested cash, no fees, no minimums, plus Public has AI baked into the entire experience already. Instant portfolio insights, earnings recaps, smarter data at every step so you're never investing in the dark, plus for a limited time. They are offering a 1% match on all IRA deposits, transfers, and 401k rollovers. Not bad. Getting started takes 5 minutes. Head to public.com/ATC to learn more. Paid for by Public Investing. See full disclosures in the podcast description. Again, public.com/ATC to learn more. Let's do this. We threw an extra question in today. I think we calculated last week, since we've done how many shows? 300-ish?
No. This is 183.
Oh, close. What did I get through?
You're only on 424 of Animal Spirits.
We've done 5 or 6 questions plus some off-the-cuff ones, so we're talking...
We've done over 1,000 questions.
1,000 questions.
Yeah.
We've got way more than that, so keep them coming, people. We appreciate it.
Yep. All right. Up first today, we got a question from Derek. I'm still a newish investor who has owned stocks since 2019. I've now lived through the pandemic where stocks got crushed only to come roaring back, the inflation bear market in 2022, and whatever the Liberation Day thing was in April. We were down 20%, now the market is up almost 10% this year. Is this just normal, or should I expect things to settle down in the future? I like this question because I've been wondering this. I got into the stock market around really 2016 or something. And yeah, I've been wondering this the whole time too. Is this... do things ever calm down, really?
It does seem like things are crazier in recent years. So, Daniel, throw up the first one. This is 2020. The huge spread between, we were down 30% at the lows, and remember, we hit some new all-time highs before then, so the actual drawdown was more like 34, 35%. We finished the year up 18%. So, the range of outcomes there was crazy. New all-time highs by the end of the year. Show this year now, the next one. This is the mini version of that, right? We were down 15% at the worst, and that was almost a 20% drawdown. Now we're up almost 8%. On the year. So again, huge range of outcomes. Now, these things are cyclical, but it's worth pointing out that intra-year volatility in the stock market is nothing new. So here's what I had Chart Kid Matt do, because these big ranges of going from down big to then up. Let's do the chart here, and I'll explain this one. So Chart Kid Matt ran the numbers for me to show the range of outcomes we've seen going back the past 100 years or so by year. So this is going to take some explanation. So leave the chart up there for me. Basically, I wanted to look at the swings from the lows to the highs. So Matt took the max drawdown each year, right? Intra-year peak to trough drawdown, which averages about 16% on an intra-year basis since 1928. He then added the return from the low point of the max drawdown through the end of the year. Still with me? Okay, so the range of the peak to trough low, and then how much did it come back? So kind of what we've seen these past few years where you have a big drawdown this year, and then it comes back. So this shows that the biggest peak to trough drawdown in a given year, plus the return from that drawdown. Okay, so the average in this time is a 32% range. You can see a year like 2020 was an outlier. It's a 100% range. So that, because we were down 30 and then up 70 from there through the end of the year, which was crazy. This year has been pretty decent so far. So the average going back to 1928 is 32%. This year is 45%. Okay, but now look at the 1930s. This is a volatile decade, but look at how bad the 30s. I don't think we're ever going to approach that level of volatility again. That was insane. But the other thing that you kind of look at the rest of the chart is that it ebbs and flows, right? This volatility is cyclical. So you have these bursts of volatility. And Jack Reacher, one of my all-time favorite book characters, once described his time in the Army as long, slow periods of nothing much with occasional bursts of something. Unless Bill Sweet later, if that actually makes sense. But we can do a chart off now. So Duncan, does that chart make sense? I know it's kind of convoluted, but it just shows like how the range of how far things can go from like really big losses to really big gains by the end of the year.
Yeah, there's a lot in that chart. But yeah, I think I got it.
Yeah, so I know that the 2020s feel out of this world in terms of volatility, but historically these bouts of volatility just happen from time to time. And it's also worth noting 2023 and 2024 had very little volatility to speak of. So you remember the bad times, but when nothing happens, then you don't really remember it. So I do think that there's something to the fact that everyone living through volatile periods of time assume that they're unique, whether it be geopolitical or market related. But this is just how things work. Now, again, there could be something to be said. I've said in recent weeks that like markets are moving faster, so that part of it is just maybe the cycles just happen more often.
Also, I guess in the 80s, you didn't have like Public, Robinhood, and Yahoo Finance all pinging you all throughout the day, telling you how much your stocks have moved one way or the other.
Yeah, I wrote about the 1987 crash once, and a guy emailed me in and said, I didn't know about the crash until I was driving home from work, and I heard it on the radio. Like, you couldn't pay attention to this stuff on a daily basis. The free flow of information was... So, yes, things have changed, and that may speed up the cycles, but those cycles have happened in the past. They just might have been elongated. All right, let's do another one.
Makes sense.
Let's start with our big-time not to brag of the week here.
Okay, yeah.
You guys need to make some sort of graphic for me. The not to brag of the week, like a little trophy or pin.
Maybe a sound effect too. Like,
yeah, there you go.
I don't know what I got. Like,
don't mean to give you guys more work, but
no, that's USA chant. Yeah, I don't know. I'll have to find something. Okay, this question is from Vincent. I'm 56 and retired with a $30 million net worth. That includes $20 million in a brokerage account, $2.1 million in IRAs, with $1.5 million in traditional and $600,000 in Roth, $4 million in illiquid carried interest from a prior private equity role. I have no idea what that means. You all have to explain that.
That's the 20 of the 2 and 20.
Okay.
This guy worked in private equity.
Gotcha. Okay. And the rest in real estate. After rolling over my 401k to IRAs, previously all equities, my CFP suggested I DCA over 12 to 24 months or wait for an 8 to 10% pullback. My brokerage firm advises staying in cash, citing concerns over traditional IRA growth and future RMDs. That's required minimum distributions. As a CFA with 35 years of experience, I'm comfortable with a moderately aggressive portfolio. I plan to draw from taxable accounts first to manage taxes and use backdoor Roth conversions within the 24% bracket. I'm looking for an objective view on whether keeping traditional IRA funds in cash to reduce RMD exposure is sound.
All right, first of all, great name. Vincent, I feel is like one you don't hear much anymore. Like, think about the movie people that have been Vincents. Vincent Vega, Pulp Fiction, right?
Yep.
We have Vincent Hanna from Heat.
Yep.
I don't think he had a last name, but Vincent was Tom Cruise's name in Collateral.
That's a deep pull. I did not remember that.
That's a great name. If
you're
someone who's... Oh, yeah. Oh, that's a good movie, by the way. The Bill Murray one?
I was talking about the musician, but...
Oh,
yeah.
Isn't there a St. Vincent movie with Bill Murray?
I think so, yeah. I haven't seen it.
So this question has a little bit of something for everyone, but we're talking tax deferrals and withdrawal strategies. So let's bring on Mr. Roth IRA himself.
Hey, Bill.
Yeah, when Vincent Vega's involved, you need the wolf. If I'm curt with you, it's because time is a factor. I think fast, I talk fast. If you guys want to get out, you need to listen to me.
All right, Bill, a lot of information in this one from Vincent here, but I think
Duncan
it boils down to this. He gave us everything, and he's doing very well for himself, obviously. But we're moving 401k funds in a rollover to a traditional IRA. And I still don't quite understand why that money has to go to cash and why we can't just do in-kind transfers. That is the dumbest thing to me, that we have to send a check out to someone and then they have to deposit it. Because we've heard of stories of people losing checks or checks getting in the wrong mailbox or whatever. I don't understand the reason for this. I guess it's because they don't want you taking your money out. But so he's got his money sitting in cash. His advisor wants him to average in and be opportunistic. And then his brokerage company wants him to park it in cash. I got to be honest, I don't love the advice he's getting here. What do you think?
Particularly since it's in conflict, right?
Well, can you guys I don't even understand what he's saying. They're saying about the RMD thing. Stay in cash For what? Can you explain that a little bit?
Okay, so that's the part I don't get either. So he's saying they're telling him keep cash in a money market because you're worried RMDs will be larger. That's like Michael Scott saying my only weakness is I care too much.
That's a good point.
I have too much money. I have to take too much out. What?
Yeah, so there's a pretty large gap too between age 56 for our guy Vincent and 73 when RMDs
Yes, he's got almost 20 years.
That's a long time. Yeah, so if we're worried about what happens in 2042, sure, I guess you'd want to earn less money for the next 20 years. That's probably not advice I would want to pay for, frankly.
No, and obviously, I'm not trying to throw his financial firm under the bus, but they like what they're getting from the money market in the interest that they can. It seems a little. I don't know. I'm not a big fan of this. Now, if Vincent was comfortable in risk, because he told us that this money was in equities before he got out of his 401k, then he's rolling it over, going to cash, and then putting it back in. If he's comfortable with that level of risk, why not just put it back to work right away? Yeah. And you miss the 2 or 3 week window or however long it takes to get the money back to you, and then the cash, and then the check,
my answer for waiting for an 8 to 10% pullback would be, what if we get an 8 to 50% increase, right? Then what?
Yes, right. DCA makes sense, I think, if you're practicing regret minimization or have a psychological block. Because we've had people like that in the past that say, I've got a huge slug. I can't physically make myself put it all on at once. He seems like he wants to.
You and Nick have finally made this make sense to me. I used to always be like, you would talk about, it makes more sense to go and put the money in lump sum versus DCA. And I was like, I don't really believe you. But like, something clicked. But I think last Ask the Compound when Nick and you were talking about it, it clicked. And now I get it. Because the whole point is, if the market's going up 0.25% a day for 2 weeks, who cares if it pulls back 8%? You still, you're not in a better place than you would have been if you just...
Yeah, exactly. The probabilities say just put it to work and stop worrying. But
time
Bill,
value money.
Any tax angle here that makes sense to you? Because if he keeps growing the money, great. Who cares? Right?
Yeah, so I've got 3 answers for Vincent, but I want to start with Vincent won the game of life. This is the not the brag of the Trump administration, and I'm talking going back to 2016, guys. This is a big one. But Ben, your tax rate is never 100%.
And also, people talk ill of the CFA. Vincent's got a CFA. Look at how well that did for him, right? $30 million.
It's a good point. Yeah. So your tax rate is always less than 100%. So to me, like holding cash to reduce R&D exposures 20 years from now, it doesn't make a lot of sense to me. I just frankly don't think that's good advice. And it doesn't make any sense to me to hold cash when there are higher yielding alternatives. Vincent, being a CFA, probably is talking about short-term interest rates, right, Ben? This is a cash alternative. Risk-free rate right now is about 4.5%. So if we're talking about a $1.5 million IRA, I don't know if it makes sense to just give up $67,000 of income, right, on that front. But answer 2, Ben, is that if you need to hold cash somewhere, and that might be what his broker or advisor is getting at, I think a traditional IRA is a great place to hold short-term, high-yield cash because that ordinary income is all tax deferred within an IRA. And I've got a quick chart to show what's going on there. Can we chart on? The yield, right, at a 24% tax rate, pretty easy to calculate. If you're holding 4.5% yielding assets in a non-qualified account, you have to pay 24% taxes. If Vincent's from Florida or Texas, that creates an after-tax yield of 3.4%. It's a really good way to reduce your wealth. Tax rates at ordinary income are the highest tax rates that you pay compared to capital gains at 15%, which would apply here. So that's just, to me, a quick, easy thing to do is that holding a high-yield asset within an IRA allows it to act as a tax shield, right? So there is a tax play there, and that's important. Third and final point for me, let's say Vincent is earning 6 or 7% of his portfolio, right, Ben? We've got real estate, we've got equities, we've got private equities, we've got stuff all over the place. He's probably getting a pretty solid yield. Vincent's compound rate of return is probably somewhere around $2 million a year, right, on a $30 million portfolio. And if he's spending anything less than that, his assets are going to continue to compound, right? If we look forward to age 66, Vincent's probably going to be worth about $46 million. If we look forward to age 76, probably about $68 million, and so on. If we go out to the 90s, again, at a 4% rate of return, so let's say he's earning 7, but he's only spending 3, Vincent could be worth probably $140 million, right?
Start spending your money now, Vincent.
Duncan,
don't let it grow that big.
Yeah, this is the time value of money at play. And so one thing that I really want to point out, and if Vincent's not talking to his advisors right now, I would give a call to an advisor or somebody at Ritholtz Wealth Management because we can help you think through this. Vincent has got more money right now than he's probably going to spend in his life. That would be my take on this.
And Dave in the chat says, hey, $30 million that compounds, he's going to have estate tax stuff as well.
He's got estate tax stuff probably right now, right? Because the $14 million is the current estate tax exemption. Let's presume that he's married. That would be $28 million, right? If a couple would have two lives. But if Vincent's single, he's got $16 million of estate tax exposure today, right? And maybe he's got life insurance to cover that. But ultimately, my point has been, I think you're right. Vincent he's reached escape velocity. Right, he has solved the problems of financial planning, and he's probably reached escape velocity. His money will compound, and so one thing I want to leave Vincent with is maybe that money just needs to go to charity. Right, maybe the $1.5 million right now, if that grows to $3 million, if it grows to $6 million, if it grows to $12 million, if that all goes via QCDs, qualified charitable distributions, which you can begin in your 70s, that's a great way to solve for RMDs, because then the charity gets the benefit of 100%. So back to Vincent's question, why would you invest in a lower yielding asset today if the money's going to benefit charity in the future? I would be investing for something bigger than that.
Yeah, great point. It's a way to help people and help your taxable situation. And Vincent, if you ever go to an apartment to kill someone, don't leave your gun on the counter while you go to the bathroom.
Exactly.
Seriously?
It's good advice. It's good advice. Yeah, you do not want to call the wolf. That they show that later in the movie.
Another question.
Okay, up next we got a question from Daniel. Thanks for all you do. Glad to hear Duncan is finally in the green on Oatly.
We're going to be talking about Oatly in like
thanks,
2060, guys. Yeah.
Yeah, I mean, someone was complaining in the comments a couple weeks ago that we talk Oatly too much. I'm like, come on, you don't get the show. But anyway, so what purchases and decisions do you wish your clients would run by you first? Which ones do you prefer they just go live their lives without asking? I'm in Ben's shoes with a looming home project that will likely spiral. Ran it by our planner, but always wondered what makes a client annoying.
All right, this is great. This is a very self-aware person, and the fact that he's asking this question means he is a good client, because the bad clients don't ask questions like this, right? Here's the thing. Financial advisors want to hear from you about this stuff. Like, the more they know about your finances and your spending habits, the better. Good advisors want to help you with these kind of decisions. Listen, I'm going to put on a 3,000-foot mudroom in my new house, like Michael. So also good on him for understanding that a project can spiral. Once you open that HELOC spigot, let me tell you, Bill, it's hard to close it off, because we're now moving on to new garage flooring, new beds for the kids. We had to take our beds apart to do our flooring. And guess what? Honest to God, my son had jumped on his bed so much that the metal bed frame was bent like a U.
Yeah. That's how they raise those kids in Grand Rapids, Michigan, right?
In the dumpster. All right, so I've got some ideas here. I'm going to hear yours too, Bill. So here's my ideas. First, let's invert it and do Charlie Longer. How to be a bad client, right? So you obsess over performance numbers. Those are the worst, right? Why am I not beating this benchmark? Why am I underperforming the S&P?
Diversification means always having to say you're sorry, right?
Yep. Constantly showing regret for like hindsight moves you wish you would have made. Like, well, wait, why didn't you buy NVIDIA for me? Why do I not have a position in Bitcoin? Like, no one ever gives thanks for keeping them out of bad investments, but the stuff you didn't buy, that's the stuff. I think worrying about macro stuff all the time, like government debt, inflation, high rates, low rates, all this, people that constantly worry about that stuff. And then I think the other one is just you can't make decisions, right? Like, here's two paths. You know, it's never black and white. It's usually gray. Like, here, going with everything we know about an irreducible uncertainty about the future, here's what you should do. I think the other one is just, obviously, market timing is a big one for people that, you know, I want to get back in and I'll just wait till the dust settles. But I think setting unrealistic goals too. Like, just pick the best stocks for me, right? I want 10% per year, guaranteed every single year. Get me out before volatility strikes and get me back in when the coast is clear. That's the bad client, right? So, Bill, now what's a good client?
Yeah, that's a great thing, Ben. I went in a completely different direction this one, and the reality for me is, Ritholtz Wealth clients. To me, these are the folks that pay our bills. So I have no annoying clients. I have no annoying dicks. These folks are at the top of the mountain for me. So I would say probably the only thing that
if your advisor is getting annoyed by you, that's on them, not you.
Yeah, I would agree, because this is a business relationship, right? I mean, it's a relationship. It's an important relationship. It's really nice to get to know somebody and understand them. But at the end of the day, these are our clients, and we work for them. And so part of our job is to never, ever cross that threshold of like feeling a little bit annoyed. I could probably turn it around and say that the only thing that would probably I might be miffed about would be something that might impact a client's financial plan, right? That I didn't know about, right? So I would take the
more
exact
information,
opposite.
the better.
Yeah, because
if someone doesn't take the advice of their advisor too, right? I mean, like, there are firms that will fire a client over that, right?
Yeah, I mean, you need to do that in obviously a very tactful and respectful way. But again, at the end of the day, this is the client's assets, right? The client gets to call the shots. The client gets to make the decisions. And I think fundamentally there's a disconnect. If the client doesn't want to let you know, hey, I'm planning on doing this. Can we talk about how this is going to impact my plan? I understand this is going to be a trade-off and things are going to change. That's a totally normal, reasonable conversation that would never go into the annoying camp. But Duncan, that's a very, very good point. If somebody's not taking advice and you're like, hey, this means you cannot retire the year that you want to retire, most likely, then yeah, there's a fundamental fiduciary conflict there that probably will end.
When we very rarely have to fire a client, we do a rose ceremony, and they just don't get a rose and have to walk away and do
No, that's not the way we do business. No,
to be a good client, here's a few ways to be a good client. Like, I think you have to just tell your advisor what you want, and if it's their job to do it for you, right? We're going to tell you what we're going to do, and then we're going to do it for you.
Yep.
And if they can't do it, they should tell you that. Like, listen, what you're asking for, we can't do. It's maybe someone else will tell you they can, we can't. I think there's no, like back in the 80s and 90s, it was kind of like, trust us, we got this. There's no more of that. You have to ask questions. Like, your advisor should be transparent about everything that they're going to do, but you as the client, like, need to trust but verify and understand what they're going to do.
It's a very good point. Trust but verify, yeah.
And so I say you can like outsource the financial planning and the portfolio management, but you can't outsource your understanding. Like, you have to understand what's going on.
Yeah, and when we've done analysis on when our advisors spend the most time with their clients, so much, Ben, of the work is front-loaded in that first 3 to 6 month period. I think because very naturally, right? If you've been investing, we have a question coming up where a client has 6 or 7 assets, 6 or 7 accounts elsewhere. Bringing that all together under one roof is a significant emotional event. And exactly like you said, you do need to trust but verify. And so I think it's just developing the relationship. Some of the harder conversations I've had to have, Ben, are when a client is out spending, right? And I know it's going to impact their financial future. They've told me that living to 95 and having X amount of income is important to them. But if the decisions that they're making in the present are going to impact their future selves, that's a really tough thing to do. But again, nothing would cross the threshold to annoying for me, personally.
Based on my current renovation for my house, you're going to have to have a conversation with me about spending because I need to rein it in.
Hey, tax deductible now with the state and local tax cap. Maybe that's.
But again, the fact that Daniel's asking this question, I think it means he's probably already a good client.
He's probably an A+ client. And yeah, you should write your CFP and tell him, I'm a good client and you're welcome.
All right, next question.
Okay, up next we got a question from Mike. I was wondering if you work with any of the following strategies: tax-aware long-short, put writing to diversify concentrated stock positions, option strategies to buffer concentrated positions, 351 exchanges. Would be great to get your insight here.
And I think Mike emailed me, and I think he was an advisor wondering about this stuff. So give me my Mugatu meme here. Honestly, Bill, we've been having tons of conversations about this internally and externally, about these strategies. And
it's late-stage capitalism, yeah.
I do think a lot of places are realizing, like, wait a minute, we know beating the market is hard, and no one can guarantee that. But if we provide tax alpha, clients love that. And a lot of these strategies are different, but maybe just from a broad general sense, you can give an idea how this is more just looking for ways to defer taxes and to diversify in a tax-aware manner, right?
Yeah, correct. Yeah, I put together some slides on this. Can we pull up slide 1 of 87? It was an 87-page presentation. But yeah, Ben, I think it's best to go quick hits here because this is PhD level stuff. So let's go quick. Let's go quick fire. Tax-aware long short, conceptually, you're able to move out of a concentrated position much faster if you're taking long positions and taking short positions. Right? Because what markets go up, Duncan? 8 out of 10 years, 7 out of 10 years. So if you're shorting certain positions, you end up with more tax losses over time, and that can help you offset. And
you're basically giving yourself more opportunities for tax loss harvesting.
Correct,
right?
However, the downside is the short side of the portfolio often is a drag on returns. It really depends a lot on the skill of the manager, and very skilled managers tend to charge fees roughly equal to the skill that they're delivering. Right? So there's a very easy way to generate tax losses, and that's to lose money. And I would definitely be mindful of that going into tax-aware long short.
Yeah. Michael was on The Unlock today talking to Wes Gray about the 351 exchanges.
Yeah.
Which is essentially just taking a handful of positions, you have a low cost basis in, putting them into an ETF that allows you to transfer those in kind and do a diversify essentially.
Yeah.
But all you're doing there, again, is you're not getting rid of taxes, you're just deferring them to the future.
Yeah, it's a great solution. I'd advise Mike or anybody who's interested, go to the Unlock, go to the Compound YouTube channel and just, it happened earlier today at 11 o'clock this morning. Wes Gray, Michael Batnick talked about 351's exchanges. They're a great solution. The problem, Ben, is it requires a basket of securities, right? You can't just contribute your highly appreciated stock into AAUS or some other ticker. Again, not advice, do all your due diligence, but you basically need to deliver a basket of stuff, and that's the big downside of 351s.
I think the big thing to know on all these tax alpha strategies, if that's what we're going to call them, is just that they require like knowledge from a financial planning perspective and like what you're actually getting, what the trade-offs are. These aren't just a free lunch here. Like you have to understand what you're getting at and understand that like you can't always let the tax tail wag the portfolio dog or whatever, right?
Yeah, you're 100% right. And all of these involve a trade-off, right? So what problem you're trying to solve, and risk cannot be destroyed, but it can be transformed, right? A different type of risk. Put writing was another one that we asked about for diversifying concentrated stock. Interesting concept. It again, really all depends on execution. And it's always very hard for me when we get to these more advanced PhD level stuff to evaluate the benefits compared to actually just selling the thing, right? Because if you just sell the thing and diversify and you give a bucket to charity, right, of your capital gains, that's a really great way to mute the tax effect depending on where you go. And it would be the same answer for options, right? I mean, all these things cost money and they require skill to execute, and that ends up being a drag on your performance. So what problem do you want to solve? Do you not want to pay taxes so much that you're willing to lose money? All of these things are an interesting option.
And these are complex strategies. They're not simple or easy to understand. I was going over with them with a client last week, and he said, "Be honest with me. How complicated are these?" I said, "They're kind of complicated." He said, "Say no more. I'm out.
Yep.
I don't want complicated
downside. Yeah, we didn't ask about exchange funds, which is another interesting solution, right? And there you can just contribute your highly appreciated stock. It requires a 7-year holding period, right? So you're liquid for a pretty long time, most of a decade. You can talk about collar advances or variable prepaid forward contracts that allow you to defer the gain, but get the cash earlier. That's a really interesting solution to this concentrated risk problem. But I think at the end of the day, a charitable contribution married with just realizing the gain, you won the game of investing, take the gain, pay the tax, high five your friends, and go to the bar.
Yeah, someone in the live chat says, if I ever get to the point in my investing career where taxes are concerned, then I'll be happy.
Exactly.
Same.
And you should.
Preach.
And it's really interesting that all these questions are bubbling up now, right? We have a $30 million net worth. Like we're at a pretty long tail, right, of a really, really good run. I'm not saying it's all going to crash tomorrow, but these problems only happen in these markets, right? And if
Bull
we had
market problems.
If we had a 20% drawdown this year, next year, 2 years from now, we're going to be talking about bonds and municipals. And it's really funny just how this is all cyclical.
Well, so Bill, I have a question on this topic. Do dividends offset tax losses? So if you have, I see a lot of these ETFs now that pay crazy dividends, but they just go down and to the right. Is that a strategy where they're getting tax losses, but they're earning dividends, so they're actually coming out on top?
It's a strategy. Yeah, I would argue that.
Or I guess what I'm saying is, do you still get that tax loss from the actual, from the principal going down? And you get to keep the dividends? Is that the idea?
But dividends are taxed at, I mean, they're not ordinary income rates or capital gains rates, and you can use the capital losses from your portfolio to offset them, but it's limited to $3,000 a year, right? So depending on the size of your investment, that's usually not going to work if you're investing more than $100,000. To me, that's some Frankenstein stuff, Duncan. It's too.
I've just wondered because I've seen a lot of these funds that have crazy, nice looking dividends, but they just seem to go down over time. Some individual stocks too. But
the craziest one to me conceptually is like these single stock things that just they do covered call writing, right? And so you get some cash, you get some income basically with covered calls. What you're doing then is you're transforming capital gains at a lower tax rate into ordinary income at a higher tax rate. Makes no sense to me. It's the exact
those
opposite
strategies
of
are
what you
not
want to
good
do.
for taxable accounts.
No, they're not. They're not. So, but it's awesome that we live in this time of financial innovation, and a lot of products are going to lose assets for people. So, welcome to the real world.
Next question.
Okay, up next we got one from Nick. My wife and I are 52 and plan on working until 65. We've been saving and investing, but it's been haphazard as to where we invest. We currently have 1.3 million in 401k, 600,000 with Vanguard, 1.5 million with an RIA, and $100,000 in self-selected mutual funds. My worry is that having assets spread out and not under one roof could be hurting us in some way. Am I just being paranoid? What are your thoughts?
This is a pretty easy one for me. Yes, your financial life would be a whole lot easier if all your assets were in the same place. Reporting, taxes, rebalancing, portfolio withdrawals, allocation decisions. You just want everything rolling in the same direction. So I think you're making your life more complicated than it needs to be.
Yep, agreed entirely. Very typical type of client, yeah, Ben, that we bring on and try to consolidate and help put all these pieces together and create an income stream so they can enjoy retirement. Go buy a boat.
That's the
go
thing. You don't
fix
want to
your
have to be
kid's
managing
bed.
all
Yep.
these accounts in a spider web of things all here and there.
Exactly.
Also,
your grandchild probably has a bed that he broke and he needs some help fixing that thing. So you should be spending your time doing that.
That's
would be
right.
my view.
If we did the bell curve of the age people say they're going to retire, 65 has got to be the median.
Yeah. Well, and there's a reason for that. That is when you're eligible for Medicaid and Medicare, and that's when you can basically have your health insurance, paid for by the taxpayers. Which, that's the reason.
Funny how that works. All right, we got one more.
Okay, up next, or last but not least, we got one from John. This is a two-parter, so stick with me. I'm having a bit of a dilemma. Earlier this year, I went under contract to buy a house. I close in 2 months, but I'm getting cold feet. I live in the town next to Vail, Colorado. I work as a carpenter, and a lot of my work is on expensive homes in the area. I have a great deal on rent. My landlord has only raised the price $150 in the past 5 years, and I'm below market rate.
That is a great inflation hedge.
That is really good, yeah. My landlord just raised my rent, so that's a little sore spot. And I'm below market rate, $1,650 a month for a 2-bedroom. The house is half of a duplex and 40 minutes away from where I currently live. I will be paying $800 more monthly in expenses, not including repairs, maintenance, and extra gas getting to work. I'll have to rent out the second room instead of living alone like I currently do. Is owning a home really worth it? I make around $50,000 a year and am trending up. I have around $40,000 I've saved myself and $40,000 I inherited when my grandmother passed away. The house is $405,000. I keep thinking about the Charlie Munger quote that basically says, do whatever you can to get your hands on and invest $100,000 and your life will change. I'm so close to that milestone. Should I ignore the pressure of this rapidly appreciating housing market in my area and just focus on that with the goal of building my wealth over the next few years before I worry about buying a house? I didn't get serious about saving and investing until 30. I'm 34 now, and I feel like I can't afford to blow this decision.
All right, first of all, John, respect to the carpenters out there. We had someone come and redo our railing for us. These people are artists, okay? The stuff that they can do with trim and very well done. They did the thing where they like ground down the edges of the things to make them like straight and rounded, and I don't know. Anyway, so here's the actual quote from
Jesus
Charlie
was a carpenter.
That's JC, all right. This is an actual quote from Charlie Munger. Excuse the vulgarity, but he actually said it. He said, the first $100,000 is a bitch, but you got to do it. I don't care what you have to do. If it means walking everywhere, not eating anything that wasn't purchased with a coupon, find a way to get your hands on $100K. After that, you can ease off the gas a little bit. Now, I don't think he's literally saying $100K, but build an nest egg, allow compounding to do the thing for you. I think that's
I was about to say, is that inflation
Is it just for inflation? What are you doing? Yeah, I know.
So to John's question here, and it sounds like he's really stressed about this. I think he gave us more information, and we chopped it down a little bit. But listen, owning a home is not for everyone. You don't have to do it just because a bunch of your friends are getting rich buying in Vail or Denver or wherever. There are downsides to owning a home. And it seems like he's figured some out. Like, he can't live where he wants to. He might have to take a roommate on. There are tons of ancillary costs and closing costs and
$800 more a month, right, Ben? Before anything goes wrong.
And let's be honest, it's gonna be more than that for maintenance and upkeep and all the stuff he's got to buy for the house.
But John's gonna be like, I can sympathize with this. He's gonna be like, yeah, it's always people who own homes saying that home ownership isn't for everyone.
Yeah.
It's like,
true, but he's already under contract. He's gonna buy one.
Yeah,
and he's still getting cold feet. So I think if his financial goals are more about building capital than building equity in a home, John, you don't have to buy. Not everyone has to. It's not for everyone. I always view a house as more of a form of consumption than an investment anyway, even though it's been a great investment for the past 10 or 15 years. If you don't want to buy a house and you're happy renting, keep renting.
Yeah. It's really hard because John is right on the cusp, right? I mean, adding $800 a month to your expenses before any repairs, before any roofs, to Ben, to your point, your kid might break his bed. Before any of that happens, that's a really tough ask, right, financially. And so all of the decision to me leans towards, I would recommend to John, break the contract. And that really sucks. You need to look at the financial impacts of that. But if you're really not feeling like this is the right decision for you after you've signed that deal and you're looking at the closing date, that to me tells me probably everything I need to know on that front. The only hesitation I would have, guys, is to Duncan, to your exact point, Like that's really easy to say, right? From 2,000 miles away. And what if when John goes back to the market, $50,000 richer, the house he's looking at is $600,000, right? I mean, it's only going to compound that problem. It's very much a possibility.
He's got to be happy renting for a while potentially.
Yeah. And really what you get with housing and what you get certainty, right? You know what your monthly mortgage payment is going to be. Yeah, the roof could leak. Yeah, the plumbing could break. Yeah, there's stuff but that's one-time stuff usually. You fix it and you move on. But really not knowing that your rent is going to go up by 20, 30%, like that's a hard thing. So Duncan, to your point, I don't want to minimize that. But it just sounds to me like John's got a pretty good life. And so changing it right now to add 48 minutes each way on a commute, spend all that time in the car, it just seems like a lot to me, guys.
Yeah, he seems happy. He seems happy with the way things are going. Here's the other thing they don't tell you about becoming a homeowner. The bane of my existence, weeds. No one tells me how many weeds you have to pull when you own a home.
Yeah.
It's constant.
Pro tip, spray bottle, vinegar. Just go to town.
I've heard that.
Yeah,
vinegar
once a week.
Takes care of weeds?
Yeah. Oh, yeah.
White vinegar, right.
Oh, yeah, you're right. You still have to do it once a week.
Yeah, it's work.
A lot of upkeep.
I think the key to me here is, do you want to have a roommate? Because a lot of people hit their 30s and are like very opposed to the idea of having a roommate. I think I was one of them. So if you don't mind having a roommate, then maybe, or if it's a friend or something, then maybe that's fine. But yeah, if you just have to like go to Craigslist and get a random person to come live with you, like to me, that would be the deal breaker of all this, is the idea of having to do that.
Yeah, I'm in a lot of trouble because I don't like the 3 roommates I live with. 2 of them are always breaking their beds. They're coming up and waking me up at 2 a.m. to come sit in a chair. There's a lot going on. If you have to get a roommate too to make the ends meet financially, that's the deal breaker to me.
That might tell you that maybe you can't afford it, right?
Yeah, it's just.
I mean, maybe the duplex thing is another investment type of thing, but again, do you want that investment to be in real estate in this one market?
Yeah. Do you want to do
or
that?
Do you want
work?
it to be more diversified?
You get one dirtbag renter, right, that doesn't pay their rent, and then you're hosed. You can't evict them for 18 months, 2 years. Yeah, it's a lot of risk to take on for
another key here is he says he has a good way, and more of it isn't jacking up the rent a lot. That's key here, because when I lived in Brooklyn, the last place I lived in Brooklyn, they raised rent like 8% 1 year, and then I think even more another year. Like, it was insane. If you live a place like that, then okay, there's a more compelling argument to buy a home maybe. Yeah. But yeah, if you're saying that they barely raised rent, then that's a pretty nice deal. Now, if he broke this, would he be on the hook for fees and things?
It all depends on the contract. Yeah, you
I would offer the homeowners some free carpentry work.
Exactly. Yeah,
right?
Do that sanded edge thing that Ben was talking about for him.
Yeah, I can put some trim in for you.
But you need to do that and then club the contract. Just shred that thing with a club. That's the way to do it. Yeah, no, it all depends, Duncan. Sometimes you do need to put down a good faith deposit, and if you renege on your side of the agreement, you're screwed. You got to walk away, and that sucks. But again, that's business. I just wouldn't let that make the decision, right? I mean, ultimately, John's having
don't make it a peer pressure
reason.
thing. Don't make it. I see everyone else buying a house, so I have to buy a house. Yeah. If you really don't want to, then don't do it. That's my only. Owning home is not for everyone.
Yeah, but we started with $30 million, and now we've got 50, carpenter, and it's. I like that this show is for all people, right?
Listen, it's a wide range, just like the stock market volatility in a given year.
Exactly.
See, I brought it all the way back around there.
John's not going to have these problems when his net worth compounds to $30 million, 20 years from now. So God bless you, John. Good luck. Let us know what happens.
Gizmo in the chat says mulch, baby, mulch. I guess as the answer to weeds.
Yeah, every year you got to put new mulch in.
Yeah. It's work. Right. It's worth it. It's nice to be outside, guys. We have indoor, keyboard jobs and keyboard jockeys. It's nice to get outside and spray some vinegar around. It smells good.
Yeah, that's the problem, though. It stinks horribly.
It strips paint.
Yeah. All right. Thank you, Bill, for joining as always. I'm glad I didn't know you could wear a cardigan in the summer, Bill. That's quite a look.
Yeah. Again, my roommates put the AC pretty low, so yeah, that's what we need
Email
to do to
us
survive.
With your questions at askthecompoundshow@gmail.com. Thank you to everyone in the live chat, as always, for firing off your questions and live chat on Twitter. And we'll see you next week.
See you, everyone.
Good luck, John.